Hello everyone, welcome to the latest TM Brunsdon market update. I hope that you're all keeping safe and well during these rather unsettled times. Pleased to have with me once again Mark Shields, Investment Manager from Brooks Macdonald, who will be discussing some of the most pressing questions that we get from you. Mark, hello there. Investment markets have been somewhat volatile of late. What's caused the recent issues in the banking sector?
Yeah, hi Brian. Yeah, you're absolutely right. As I'm sure most people are well aware, we've seen another sort of series of issues, shall we say, within the banking sector, particularly with smaller regional banks in the US first becoming affected, SVB and First National being two examples. But that sort of concern over the situation with banks has now also spread to Credit Suisse. And in fact, we've seen over the weekend a rescue deal, in inverted commas, being put in place where essentially UBS has acquired Credit Suisse for a significantly downgraded share price. So really, this has been it's two separate issues that have morphed into one. The issues with the regional banks in America have been largely because they were essentially taking in deposits from depositors and investing those deposits into debt, either that being corporate debt or indeed a little bit of sovereign debt. So corporate debt is debt issued by companies, sovereign debt is debt issued by countries. And they basically were buying that debt right at the peak of the market. And then we saw that debt decline in value quite significantly. And essentially, in a sort of very sort of basic terms, they were unable to continue to meet their clients' requirements when they were looking to withdraw cash because they had to write down the value of those investments that they had used. Credit Suisse was a similar issue, but actually there's been issues with Credit Suisse going back even further. And there's been a lot of questions about Credit Suisse, Credit Suisse's broader operations for a longer period of time. But essentially, the story within the banking space is similar, and we've seen quite a lot of volatility off the back of this. We've seen a lot of pressure come on to banks in general, and we've seen questions being asked with regards to whether we are seeing another run on the banks like we saw back in 2007, 2008. We're not convinced that's necessarily the case, but there are some potential issues within some of those smaller banks where we don't really have much exposure. But it's something we're watching very closely.
Okay, so that's a good segue into my next question, Mark, which was with regard to the BAM funds, the cautious and the adventurous. How much actual exposure have we got to banks?
To banks, we do have some exposure. To SVB, First National, and Credit Suisse, we've basically got no exposure directly whatsoever. I think we managed to find one of our passive funds at about 0.02% exposure to Credit Suisse, so very, very, very small indeed. So we don't have any real direct exposure to Credit Suisse. We don't have any exposure at all to those regional US banks that I mentioned. We also don't have any exposure to as far as we can tell, to the what's called the AT1 debt of Credit Suisse, which is a higher risk debt category that is typically issued with a slightly higher yield. But the idea is that essentially that would be written down if a company were to go bust. So it's a higher risk element of the debt structure. Again, we don't really have any exposure to the AT1 debt within our portfolios, but we do have exposure to banks. We do have exposure to big banks, the HSBCs, the Barclays, the Lloyds, the big American banks. We do have some exposure there within the portfolios. And in fact, banks have actually performed pretty well over 2022 on both an absolute and a relative basis. We have seen some pressure on the banking sector more broadly. However, we think, again, as I said earlier on, we think that the likelihood of these issues that we're seeing morphing into a much more severe financial crisis type situation are not the risk level isn't the same as we saw sort of 15, 16 years ago. We don't necessarily expect that to happen this time round. And in fact, if anything, we feel that the likelihood is that the big banks might actually be beneficiaries of essentially people moving their money out of smaller banks into the well-capitalized larger banks. And that is a trend that we may continue to see, but that would actually be of benefit to the sort of banking exposure that we have in our portfolio. The risk, we believe, the risk is that unlike in the UK is dominated, the banking system in places like the UK is dominated by a limited number of very large banks. But places like America, yes, it has some very, very large banks, but it also has quite a range of regional smaller banks. And the concern, like SVB, and the concern is that we see another run on those regional banks in the US for the reasons that I've already discussed. And again, whilst we have no direct exposure to those regional banks, the concern is that then might have a knock on into the broader corporate world. But it could be that you could be invested in almost any sector and that could potentially have an impact. So that is more of the concern rather than the direct impact on the banks themselves.
Okie dokie. So looking ahead then, Mark, what are your thoughts, not necessarily just to do with the banking situation, but what are your thoughts ahead with regard to the investment markets?
Yeah, again, I think as we've discussed before, Brian, I think we've been reasonably cautious with regards to the positioning of our portfolios throughout the latter part of throughout much of 2022, but especially the latter part of 2022 and the beginning of 2023. We didn't really necessarily buy into the rally that we had seen really since October through to about February. We've maintained our cautious stance, and that's largely because we feel that there's been a mismatch between where interest rates are likely to head and where the market was kind of pricing in those expectations. What I think has happened over the past few couple of weeks has added an entirely new paradigm to this question as to how aggressive central banks are going to continue to be in their fight against inflation, because clearly the rate at which the key central banks have been raising rates is starting to cause issues in the sort of financial system out there. And the question remains whether they're going to continue to raise rates aggressively to prioritize bringing inflation down, or whether they're going to maybe take their foot off the brake a little bit in order to try and stabilize the monetary system. So this has really added in a new sort of twist, as it were, that in the near term, it's difficult to predict where things are likely to head, because it does seem to us that inflation is remaining sticky. But we're now looking, or now we think that there are some potential sort of cracks beginning to appear. And as to what direction the central banks are likely to take is really going to govern where risk assets are likely to head for the next sort of 3 to 6 months. Fundamentals over the longer term still look reasonably compelling. So we want to be sort of investing with half an eye on that. But I think for the next 3 to 6 months, maybe 9 months, maybe the rest of this year, we probably want to maintain our more cautious stance until we're a little bit more comfortable that inflation is starting to come down properly and we don't have any sort of, something hasn't been broken, if that makes sense. So
Okay.
for now, we feel caution is where you want to be positioned, at least in the near term.
Okay. Okay. Well, thank you for that, Mark, and thank you once again for watching. As always, if you have any questions or queries, please be in touch with us. Thank you.